Welcome to The Explainer. We're always told to trust the numbers on a spreadsheet. But what if the biggest risks to a company's value are the ones you can't even see? Today, we're going to uncover 3 hidden dangers that are lurking just beneath the surface of a typical financial model.
See, every valuation tells a story. But standard models, well, they often tell a fairy tale, assuming the company is going to live happily ever after. They're built on this idea that the business will last forever. But what happens when that core assumption is just plain wrong? What if the story could end abruptly?
So here's the game plan. We'll kick things off with the fundamental flaw in most valuations. Then, we'll get into 3 critical adjustments for distress, illiquidity, and dilution. And finally, we'll pull it all together to build a much more realistic picture of what a company is actually worth.
Okay, so at the core of pretty much every financial model is this big idea, the going concern assumption. It's this belief that a business is stable and, it's just going to keep operating indefinitely into the future. But we all know, from dot-com bubbles to financial crises, that's definitely not always true.
And because of this built-in optimism, a standard discounted cash flow, or DCF model, can completely miss one of the biggest risks there is. It's a risk that your cash flows won't just be a little lower than you expected, but that they might just disappear entirely. We call this truncation risk. So our first hidden danger is financial distress, that very real possibility a company simply won't make it. And to see just how wrong a standard valuation can be, let's look at a real-world example.
And right here, this is a really important distinction. See, most models can handle uncertainty, the chance that cash flow might be 100 million or maybe 80 million. But what they really can't handle is truncation risk, the chance that the cash flow suddenly drops to 0 forever.
So to really see this in action, let's turn back the clock to early 2009. The casino operator Las Vegas Sands, they had this phenomenal growth story, building these massive casinos all funded by massive debt. But after the 2008 financial crisis hit, well, the party was over, and the company found itself just buried under that debt and teetering on the edge of collapse.
And this is where the 2 stories just completely collide. A standard DCF valuation, the one that assumed the company would pull through and get healthy again, suggested the stock was an absolute bargain at over $8 a share. But at the exact same time, if you looked at the company's bonds, they were screaming a completely different story, an overwhelming 77% probability of bankruptcy.
So what do you do with that? You have to weigh the outcomes. You've got a 23% chance of the stock being worth $8.12, but a massive 77% chance of it being worth absolutely 0. When you factor in that huge risk of failure, the distress-adjusted value just plummets to $1.87. That's the staggering impact of accounting for distress.
Okay, next up is a risk that affects pretty much everything from private businesses to small public stocks: illiquidity. What if you own an asset, but you can't sell it quickly without taking a massive haircut on the price? Well, that difficulty has a cost, and it's something standard models almost always ignore. I absolutely love this way of thinking about it. Just imagine you buy a stock on your laptop. A second later, you think, man, I wish I hadn't done that. For a huge, heavily traded company like IBM, you can sell it almost instantly for a tiny cost. But what if it's a small, rarely traded company, or maybe a piece of real estate? That buyer's remorse could cost you 5, 10, maybe even 20% of your investment just to get out.
So the penalty you pay for illiquidity really boils down to 2 things: how much it costs you to trade and how long you plan to hold the asset. For example, let's say there's a 2% transaction cost. A short-term trader who's flipping the asset every single year faces a massive 20% discount. But a long-term investor holding for 3 years, well, their discount drops to less than 7%. Your time frame is everything.
So how do you actually apply this? Well, there are basically 2 ways to go about it. The most common is to just do your valuation as you normally would, and then apply a discount or a haircut right at the very end. The other method is to build that penalty right into your calculations from the beginning by using a higher discount rate for less liquid assets.
All right, last but definitely not least, let's tackle our 3rd hidden danger: dilution. This happens when your ownership stake in a company isn't quite as secure as you think it is, usually because the company has granted millions of stock options to its employees, creating a potential drain on your value.
This is such a critical question for investors today, especially in tech. Think about it. Those options give employees the right to buy shares in the future at a fixed price. And when they do that, more shares are created and your piece of the corporate pie gets smaller. So how do you account for that overhang?
Analysts often try to use shortcuts here, and honestly, they're almost always flawed. One mistake is to divide the company's total value by a fully diluted share count. That's just wrong because it ignores the cash the company gets when employees exercise their options. The other common method, the treasury stock method, it's a little better, but it still fails because it ignores the full value of the option itself, especially its time premium.
Thankfully, the correct method is actually a pretty straightforward four-step process. First, value the entire company's equity. Second, you value those outstanding options as if they were a separate financial thing. Third, you subtract the value of that option claim from the total equity value, and then finally, you divide what's left by the actual current number of shares. No games with the share count, you treat the options like a legitimate claim that has to be paid off first. So by putting these three pieces together, distress, illiquidity, and dilution, we move way beyond a simple and, let's be honest, often misleading number on a spreadsheet. We get to a much smarter, more durable, and just more realistic assessment of what an investment is truly worth. So here's the big takeaway. A great valuation isn't about finding one magic number. It's about asking the right questions. Instead of just asking, what is this worth, you start asking, what's the real chance of failure here? What's the cost if I get stuck in this investment? And how much of this company's value is already promised to other people?
And that really leaves us with one final thought to consider. Maybe the goal of valuation isn't to find a single, precise, right price, but it's actually to understand the whole landscape of risks and the hidden dangers that are lying just beneath the surface of the numbers, because that's where the true insight is really found.